And so we're seeing a trade-off now that interest rates have got to be high enough for the creditor, but not too high for the debtor. And so you're seeing now this adjustment in which you're having sort of a 1%-ish growth rate, not the household sector having a problem, but those who are holding the bonds and so on, they're having the problems. And so you're seeing growth come down with still an inflation issue. The inflation issue comes from two parts, really. First of all, if you spend a lot more than you earn and you give a lot of money in credit, you're going to have an inflation. But it also comes from the supply-demand of bonds. So if you look at who's benefiting in this, the household sector, the workers, are benefiting. This isn't a classic recession in which the unemployment rate goes up, because the unemployment rate is remaining relatively good because there's wealth transfer, and you have, and they are also having higher wage gauges. And then you have the inefficiency of the global supply chains, which happens there. So what that means, I think, is that you have this stubbornly high inflation. We're not going to go down to our targets for a number of reasons. And then there has to be the real interest rates remaining high in that. And that creates a sort of stagflation kind of environment.
So let's talk about that stubbornly high inflation.